You've got a lot to do. Wouldn't it be nice to have a little less on your mind? Eide Bailly can take the pressure off your day-to-day accounting, taxes, data issues, and other business needs. What inspires you inspires us.
This is the Art of Dental Finance and Management podcast, brought to you by Art Wiederman, CPA with Eide Bailly. Whether it's taxes and investing or planning wisely, Art is the expert to make your dental practice profitable. At Eide Bailly, what inspires you inspires us. We provide a suite of accounting and advisory services dedicated to the total care of your practice. Visit our website to access our tools and resources tailored for dentists, eidebailly.com/dentist. That's EIDEBAILLY.com/dentist. This podcast is distributed with the understanding that Art Wiederman, CPA, and Eide Bailly, LLP are not rendering legal, accounting, or other professional advice. Listeners should consult with their business advisors before acting on any of the information or opinions shared. If you have questions and or feedback, make sure to email Art over at awiederman@eidebailly.com. That's AWIEDERMAN @EIDEBAILLY.com. You can also give Art a call at 657-279-3243. Without further delay, here's your host, Dental CPA Art Wiederman.
And hello, everyone, and welcome to another edition of the Art of Dental Finance and Management with Art Wiederman, CPA. I am your host, Art Wiederman. Welcome to my podcast, and I am proud to say that as of 2 days ago, because we're recording this podcast on Monday, December 5th, and it will be published on Wednesday, December 14th, to give you some ideas about our topic today, which is very timely. I am celebrating my 4th anniversary of doing this podcast. The first one I did was with my dear friend, Alan Schiff, who's the president of our Academy of Dental CPAs, in Baltimore, Maryland, on December the 3rd of 2018. We are now, I think, at about 165 publications and thousands of people that listen every month. And thank you so much for your trust and faith in me and the information that we're providing. And today we're going to have a very, very timely topic. It is our annual Let's Save You Some Money on Taxes podcast. And I couldn't have a better partner in crime and guest than my good friend Mel Schwarz, who is the Director of Legislative Affairs for Eide Bailly, the firm that I am affiliated with. I am a dental division director at Eide Bailly. And Mel has 38 years of experience. We'll tell you a little bit about him in a moment. The great thing about being with Eide Bailly, which I did not have access to before I was part of Eide Bailly, is that Mel has his ear to everything that's going on in Washington. What kind of new laws are coming out? What are they thinking about for year end? What's Secure 2.0 looking like? We'll talk about all that today, and you're not going to get any more updated information as far as what tax legislation looks like than you are on this podcast. I have no problem saying that, folks. So before we get to Mel, I want to share a couple of things with you. First of all, please go on to the website of our wonderful partner, Decisions in Dentistry magazine, www.decisionsinDentistry.com. The best clinical content that there is in the dental profession, the top clinicians from all over the world covering up-to-date clinical topics, as well as 140 continuing education courses at a very, very reasonable price. Go to www.decisionsindentistry.com. My mothership is the Academy of Dental CPAs, 25 CPA firms across the United States that represent over 10,000 dentists. I was a founding member of this group. We have 46 offices in Eide Bailly in the Western United States and work in those neighborhoods. I happen to be in Tustin. Mel happens to be in Washington just because that happens to be where the government is, and it's probably a good place for him to be. He's not in the Western United States. Their website's www.adcpa.org. So I wanted to let you know that I'm going to be having some dates for you folks in California. I am working with my good friend Katie Fernelli, who is the management consultant extraordinaire that works for the California Dental Association. And the California Dental Association is making a huge effort to help young dentists that are just starting out and either looking at their options of starting a practice or buying a practice or going into corporate dentistry. And we're going to be doing live seminars, two of them in Southern California in March, and two of them in Northern California, I believe in San Jose and Sacramento, in June. In addition, I have been told that I will be presenting both at the Southern and Northern CDA conventions. So if any of you guys want to take a vacation from out of California into California, the CDA South is in May and the CDA North is usually in September. They're changing the CDA North from San Francisco at the Moscone Center to somewhere in San Jose. I don't quite know where that is, but I will find out because it would be a good idea for me to know where I'm going. And so we'll give you some dates and topics coming up shortly on that.
Be sure to check out our new Eide Bailly podcast, Ebb and Flow, a business podcast providing inspired insight on issues and trends the middle market faces. Hear unique business stories, get answers to frequently asked and unasked questions, and understand business topics that matter to you. Available now on your favorite podcast platform.
So let me get to my good friend, Mel Schwarz. Mel is an invaluable resource, not only for me, but for our entire firm at Eide Bailly. He has incredible experience. And again, as I said earlier, you just don't get this kind of information unless you have somebody sitting there and talking, to the folks in Washington, talking to Nancy Pelosi's office, talking to Chuck Schumer's office, and the folks on the House Ways and Means and the Senate Finance Committee. So Mel has over 38 years of experience specializing in legislative affairs, including development and implementation of tax legislation at the national level. He spent 6 years on the staff of the Joint Committee of Taxation and has served as the chairman of the Tax Legislation Committee of the American Institute of Certified Public Accountants. He oversees Eide Bailly's monitoring of federal tax legislation and the regulations implementing that legislation and shares that knowledge with the firm and its clients. And he is a very much sought-after speaker for many AICPA, TEI, and FEI conferences. And, of course, he is much smarter than your host, which is why I have him on. Hi, Mel. Welcome to the Art of Dental Finance and Management.
Well, thank you, Art. I wouldn't shortchange your knowledge here, Art. I think that I learn many things as I participate in these webcasts with you, and it is always a pleasure to be a part of this.
Well, you're very, very kind, and I think this is the second or third time you've been on the podcast. And I mentioned a little bit about your journey. What tell us a little bit about your career before we get into all the great stuff we're going to tell our folks on the podcast today.
Oh, it's a not a typical Washington, D.C. story. I came in the summer of 1984 on a 1-year tour of duty and never went home. Now, I did marry a local, so I have that to argue for. But that's the background. I was fortunate enough to spend the time on staff, the Joint Committee on Taxation, which is it is a shared staff for the Finance Committee and the Ways and Means Committee, the two tax writing committees in Congress, of essentially technical people, not intended to have necessarily a partisan push, but one that can go through, can keep track of how the changes that are proposed in legislation can interact with what is already in the Internal Revenue Code, for instance. We're also the ones who publish the revenue estimates, which you may have heard referred to in the popular press. And although I was not one of the economists directly responsible, I was one of the attorneys, accountants responsible for explaining to the economists what it was going to do.
What does it mean?
So if we completely blew the estimate, it's, I guess, at least partially my fault.
That's right. Now, isn't there something in the tax law, Mel, that says that anytime they put in a provision that cuts revenues, they have to have a supporting provision that raises revenues, or does that go away?
No, that is part of the budget process. So that if you're going to pass tax legislation, for instance, in the context of budget legislation, typically they require that there be offsetting revenue raisers. That's not a firm and fast rule, although I think there have been past chairmen of the Ways and Means Committee that have complained that the rest of Congress figures out to spend the money and then sends the bill to the tax writers and asks them to come up with the cash. Fortunately, that we've moved away a little bit from that, but that continues to be a concern.
Now, well, revenue is a concern, especially since our country is over $31 trillion in debt. And I certainly don't see it going down anytime soon. And I'm sure you have a much better handle on that. Let's start talking about, let's see. Today is the 5th of December.
Yes.
Tomorrow, the two folks in Georgia are going to, Raphael, Warnock? Did I have his name right? Warnock and Herschel Walker, the Heisman Trophy winner from Georgia. They are going to face off in a very hotly contested race, but the Senate has pretty much been decided. If let's see, Warnock is, let me get my Democrats and Republicans right. Warnock is a Democrat and correct. Walker is a Republican. And right now we are at 50 to 49 in favor of the Democrats, right?
Yes.
So if Mr. Warnock wins tomorrow, we'll be at 51-49, which gives the Democrats a sliver hairline advantage of doing stuff in the Senate, as opposed to what they've had the last 2 years, which is 50-50, where Vice President Harris had to break any ties, right?
Correct.
Yeah. And then the House has got, 3 or 4 in favor of I think it's 3 or 4 seats in favor. Was it 221 or 222?
That's 222 is where we think the number is right now, but it is an incredibly narrow margin. In the House.
So with that said, we have a Democratic Senate, a Republican House, and a Democratic president. What does that mean for tax legislation? Let's start that discussion.
Well, I think that many people would simply say it means that nothing's going to happen. That the two sides cannot get together, will not get together. I think that probably overstates or is too pessimistic. There are some things that are popular on both sides of the aisle and very easily could be enacted, could be passed and signed by the president. You mentioned, I think, earlier on the issue of some of the retirement change.
Right.
I think that's one to very much stay aware of and stay focused on. Whether we can get to the bigger questions of things like when the Republicans passed the Jobs Creation Act back in 2017, a number of things were included for the convenience of the revenue estimates because they didn't have to be revenue neutral. They didn't have to hit zero, but they did have to hit a target. And so to hit that target, they included some revenue raisers, frankly, that they never intended to become part of the law. Well,
like what?
Changing the ability of corporations to deduct interest, right. Legitimate interest.
Yeah.
Rules with regard to whether whether you get to deduct or are required to capitalize your research experimentation. There are some other provisions dealing with the taxation more on the individual side that are of concern. And in fact, one of those is a potential rate increase that will occur in, I believe it's 2026, if we do not see something happen between now and then. Now, 2026 is a ways off. Some of these other provisions are already taking effect. For instance, the businesses that engage in research are already supposed to be capitalizing their research expenses, which no one, I think, ever really thought would become part of the law. But it is. It has gone into effect. There will be a big push on the part of particularly the House Republicans, to overturn these items, to fix this problem. There will be resistance to that. Part of it, I think, is going to be Democrats are likely to say, well, you guys wrote the legislation. Why are you asking us to fix it for you now?
Yeah, right.
Which
Exactly.
Unfortunately is a habit that both parties in Congress have gotten into. But I think those are some of the things that we're looking to see. I don't see anything that would be radical in the way of revenue tax increases being passed really in the next 2 years.
Now they did say, I mean, President Biden ran, and again, we're not, folks, you know me, it's 4 years now. I just mentioned 4 years. I don't do politics on this podcast. You want to do politics, you can go to any number of political podcasts are out there and you can listen to that to your heart's content. But we talk about politics to the extent that it affects tax law. And President Biden ran on the provision that he was not going to raise taxes on anybody who made less than $400,000 as a joint return. Is that do you remember that?
That's exactly right.
Right. And so I've heard things, and I'm wondering your comment before we get into some of these details is, so do you think that if the president wants to get something, going, some tax legislation going, maybe raise rates on, higher income people, which Democrats tend to want to do. And again, not a political comment, just that's what happens is, do you think President Biden might want to horse trade some other non-tax issues to get some of that? Do you think we might see some of that?
That is possible. I think particularly if you're talking about something like a rate increase, particularly an individual rate increase, which I think is going to affect most of the people who are listening here, it's very doubtful that the votes for that are there. Right. There are Democrats who would vote against that. I think pretty much every Republican would vote against that. It doesn't seem to me to be the kind of thing that is likely to be traded. In some ways, trades that raise taxes and cut spending are very, very difficult to do politically. I mean, there are deals on the table right now. Well, you spend this and I'll spend this and we'll all go home happy.
Yeah.
That is that tends to be the direction that it's easier to go that direction politically than it is to take the harsh medicine of either real cutting spending, or increasing taxes. So I don't see that. I mean, maybe if you talked about a billionaire's surtax, that is a small enough group, but I think the millionaire surtax, that's going to be a stretch under who has currently been elected, and I'm not sure I see what would be they would trade. I don't see what would be traded for that.
Yeah, I don't know. I've just kind of heard things about that, but that's why you have your ear to the grindstone here.
I mean, I think that Biden has shown that he can grasp reality, and that sometimes you don't have the votes.
Yeah,
and it's particularly a lot of this. The next 2 years are going to be, the political side is going to be focused on getting ready for the 2024 elections, both in Congress and the presidency. And the 2 years before the presidential election are much harder to enact legislation in than the 2 years prior.
Which makes people who are doing CPA work very happy because, I mean, you and I have both been in the tax profession 40 plus years, and you get to the point where you just say, guys, just leave the damn tax law alone. Let us figure it out before you change it again,
That would be, there would be much to be said for that. There would be much to be said for that. I think that the one thing that I will say about the idea of legislation, we did mention I think there is pension legislation that there seems to be some general agreement on. We can talk a little bit about that later or now.
We will a little bit later. Yeah,
that is likely to move forward. There are various tinkerings with things that don't work very well right now that they might be able to get to. One of the things that there are enormous questions about fall in the international area. And it actually may well be that if there is going to be tax legislation, the international questions are going to be what suck the oxygen out of the room and sort of leave the rest of us alone.
Yeah, well, and that is not something that generally affects the folks that listen to this podcast, so we won't get too much into that today. So let's get into some of the topics I want to talk to you about. First of all, we've been talking on this podcast about the employee retention tax credit for the last 2 years, and I have been harping on my soapbox here on this podcast, on webinars, and to anybody who will listen to me, that there are bad players out there. Mel, you and I have talked about this at length. There are companies, I even mentioned on the webinar that you and I did last week. In fact, if any of you want to, you really want to learn about tax law, we did a real deep dive on Friday, the 2nd of December, Mel and I, in our Business of Dentistry webinar series, which will be up on our Eide Bailey YouTube page probably sometime this week, the week of the 5th. And you can certainly listen to it. We're not going to get into everything today that we talked about on Friday. But we did talk about the employee retention tax credit and how this is a credit that there are companies that have sprung up that are literally making illegal claims, calling business owners. I think I mentioned email. I got a call on my cell phone from a number in Texas, and a very intelligent lady called me and said, hello, sir, have you heard about the employee retention tax credit? And you can get up to $26,000 per employee. And how many employees do you have? And wouldn't that be great? And that's how she started out. And I just don't have the patience or the time to deal with that. But the fact is that there are a lot of players out there that are charging fees of 25 to 35% or more of the credit that are they're just going to basically set people up for big problems. So Mel, you and I talked about this, and Washington is well aware that, if your goldfish died or you have just had a root canal, that doesn't qualify you for the employee retention tax credit. So what's IRS doing about this, and what are they saying? I want my listeners to hear this straight. I'm not going to straight say it from the horse's mouth, because that would not be a very nice thing to say to you, and you are my friend. So let's just say from someone who's in the know.
The IRS is targeting this. And this may be one of the items that actually was included in the legislation that passed this year, the tax legislation, was significant additional money for the IRS to spend on enforcement. And this is expected to be one of the ways that they spend that money. It's relatively easy for them to pick out situations, and you have to meet very, very specific rules in order to claim either you have to have a diminution of economic activity, or you need to have been told by a government agency that you needed to shut down. Okay. It's fairly easy for the IRS to turn around and say, okay, show me your numbers. Did you really have the decline in earnings? Or show me the order from the local government that said you had to shut down. If you can't produce one of those two, I think that you are likely in the crosshairs, and the IRS is coming. And the IRS is coming after particularly people who may have filed for these claims in part as a response to the kind of boiler room calls that you mentioned. Yeah. The IRS can use a technique called a John Doe summons to essentially go to one of these promoters and say, well, you go to the judge and you say, Judge, give us a summons that requires the promoter to send us a list of everybody they did business with respect to this. And the judge will say, why should you get that? And the IRS will say, well, we have examined X number that were associated with this promoter, and all of them were defective. And the judge will say, okay, where do I
may
say?
I have another? Exactly. I mean, and so I'm reading right here an article from Tax Notes, and it says IRS training materials explain how examiners should scrutinize the use of the employee retention tax credit, which the agency warns is being abused by third parties with schemes targeting employers that are ineligible for it. So in other words, the IRS knows the name. There is actually a form that you can fill out. I don't know the number off the top of my head, that if you have been approached by a promoter that you believe is asking you to do something illegal, you can turn them into the IRS. And I guarantee you there are CPAs out there whose clients have called and have said, this is really annoying, and my client expects me to buy into this because so-and-so said it was good, and they said you can take it on TikTok, and things like that, right? And so all we're going to say, and I don't want to go much further on this, Mel, because we got a lot of other things we want to talk about, is that be very careful. If you have any questions about this, please email me at awiederman@eidbailey.com. I have done, supervised, reviewed in great detail over 125 dental practices that we've gotten over $5 million for. Our firm has done probably over 1,000 of these. I've looked at the list. It just keeps going and going for all types of businesses. In my opinion, there are very few CPA firms that know these rules better than Eide Bailey does. We have a team, our partners, Joe Sutter, Jim Donovan, Tanya Rule. They're on top of this. I call them with question stuff. So just be careful, folks, if something doesn't smell right. All right, let's go to the next one. We had this thing called the Inflation Reduction Act that got passed. And I heard that they are basically adding $87 billion over the next 10 years to the IRS's budget, and they want them to hire, 80,000 employees, Mel? So should we all be stop writing our dog off as a dependent and stuff like that? What does this all mean?
I would advise not. I would advise you go ahead and stop writing the dog off as dependent.
Well, now wait a minute. My dog helps me in the business. Yeah, come on. Please, really. I get there's got to be some advantage of doing taxes and helping the government for 40. No, I'm just kidding. No.
I thought they shut that down when they required you to provide his social security number.
You may have a point there. I'm telling you.
That may be that may be something that the IRS should consider spending some of this $89 billion that they've gotten is to cross-reference the social security numbers and see whether they actually exist.
Yeah,
it is. I think there has been a number of things that have floated around on the internet that have talked about that sort of the sky is falling as a result, that this is going to be an army of IRS agents that are going to march in and audit every human being. That goes way beyond. Well, for one thing, that's nowhere near enough money to accomplish that. The reality is, their hiring plans, and these are hiring plans that were conditioned on getting this additional money, are more in the area of 5,000 to 7,000 employees per year. And that's a gross number. That's not a net number. There are a tremendous number of IRS employees that are eligible for retirement pretty much at full federal retirement pensions. So what the net number is going to look like is going to be nowhere the size of some of the numbers that you hear discussed. A lot of the money, in fact, over half the money is directed at things such as improving the IRS computers, having somebody answer the phone when you call the IRS, and maybe processing the couple of years worth of backlog that they have on returns right now. So it's not yes, there's going to be more activity. I think we should be looking for activity in areas that either are easy to focus on or are things that are of particular interest and possibly fairly broad interest. So what you state about the employee retention credit, the ERC, I think that's very timely. That is one area that I would expect them to send, particularly some of their newer agents, out to look at. Another area that we know that that IRS is always concerned about are transactions in cryptocurrency. There is a belief in Washington, whether it's correct or not, there is a belief in Washington that a significant number of cryptocurrency transactions are trying to hide something. And that is always an area, creates a sense of suspicion that is can lead. So I would be, I think these are two, and I don't want to say that, there is no way to legitimately claim an ERC, or there is no way to, and I guess now what we're going to be looking at is people claiming some capital losses with respect to their cryptocurrency.
Oh my goodness. There was a 32 billion. And oh my God, it was incredible. That the guy he actually agreed to an interview. I don't know if you saw that. The CEO, he looks like he's about 12 years old. And he talked about how he made mistakes and all this stuff. And this is all on TV, on the internet, so I'm not giving up. His mother and father are Stanford law professors. That's crazy. And so, what happens with all that money and all that? I mean, that's again, I don't have a PTIN number anymore, so I don't have to worry about that. Nor do you.
It's like investing with that guy in New York City.
And unfortunately, I did have some people who did invest with him.
Yeah, it is.
All right, so we shouldn't be really super afraid. I mean, the IRS's computer system is circa 1960. Yes. You've experienced it. I've experienced it. I think the statistic, Mel, was that the IRS answers maybe 11% of phone calls on a timely basis. I mean, it's a ridiculous number. So they really need to improve their customer service.
They desperately need to improve the customer service. They desperately need to improve their ability to process the returns. And the expectation is that money a lot of this $89 billion will ultimately be dedicated to those areas. And that is because I think that's where the need's going to be. We're going to have, with the Republicans in charge in the House, we're going to have some fairly close supervision of how this money is spent. Right. And hopefully that will move it in the service direction. Not to say that there's not some benefit to additional enforcement, because it does seem unfair that you pay your taxes, why doesn't the other guy pay his taxes? On the other hand, the system needs some help right now, and
they fell behind for 2 years of COVID, so they were shut down completely for almost a year of that. I mean, from what I understand.
Yes, and you can remote work only does so far. At some point you've got to be on site.
All right, let's save these folks some money. So I know that there's almost $500 billion maybe in new energy incentives.
Yes.
In the new rules. And I think for the dentists, number one is the electric cars. So we're not going to we could spend 2 days talking about the new electric car rules, but from a high level, kind of talk about if someone is thinking in the next, again, this is coming out on the 14th of December. So in the next 2 weeks or 2.5 weeks, your accountant says you need a write-off, go buy a car. All right. So let's talk about if you want to buy an electric car, how does that all work?
Well, right now, there are still some what we would call limitations on the ability to claim. We're going to get a bigger credit. We're moving up to a $7,500 a car credit. Now, there are some limitations here based on what the sale price of the car is. There are some limitations based on how much money that you earn. So if you're over that sort of magic $400,000 tax income for a married couple, you're maybe limited in your ability to access these electric car benefits. But It is going to be more, and I think more importantly, what they have done is they've taken the mark by mark limitations. Used to be Toyota could sell so many, and GM could sell so many, and Ford could sell so many. Those sort of limitations are taken away beginning in 2023. Now, what substitutes for them is some requirements for domestic content, domestic assembly, which at the moment there's some question as to exactly how they're going to apply, and there is some question as to which cars are going to satisfy. So I hate to say this, but if you are really interested in an electric car, certainly waiting until 2023 to make the purchase, and even going beyond, maybe even going beyond January and February until we see some settlement. One of the changes we may see, and I think is being pushed very hard, is to loosen up some of the domestic content requirements, at least in the beginning. And that will give more companies an opportunity to advantage these credits in connection with the electric cars. So wait a couple of weeks at least. On the other hand, if you are looking, if this is a tax play and you don't specifically want to participate in the electric cars, or you say, okay, I only keep a car for a couple of years anyway, or maybe I only keep a car for a couple of years, I'll get the electric car in 2024 when all this settles.
Right.
And
one thing they could do. Now
buying the car this year, I think, begins to make some additional sense because we are going to have a change in the depreciation rules beginning next year. We have gotten used to the idea that you can pretty much expense any capital asset that you purchase. There are still going to be opportunities to expense capital assets, including the car that you use in the business. But if you don't fit into that special category, the percentage that you can deduct on the front end is going to go from 100% to 80% next year. So and that may apply to some of the other things that you might be considering for putting in your business, perhaps even more than the car.
And we'll get into that one in a second. I want to get back to the electric car. So I'm thinking, Mel, that if you are looking at a car, and one of the things you and I have talked about is that you really have to lean on the dealer, the car dealer. You have to go to the car dealer and say, listen, is the car that I'm looking at buying from you, has it hit and I think in most cases it's 200,000 sold domestically, if I remember correctly. I could be mistaken. So I know that many of the Tesla models have hit that because obviously Tesla has become one of the most popular automobiles on the road. I know we talked about maybe some of the Toyota brands. So if you're looking for a tax write-off for this year, and you want to buy an electric car, and with an electric car obviously comes non-tax issues such as charging stations. We don't have as many charging stations in this country as we have gas stations. So, if you need a car that's going to go 500 or 600 miles on a charge, most of these cars don't do that. Some maybe do. I'm not an expert in electric cars, but if in 2022, folks, you want to buy an electric car and it hasn't hit the limit and it qualifies and don't have all these domestic assembly requirements in them, and I think there's an August 8th date that you have to look at, or August 23rd or something like that. And again, we don't have time to get into all of that on a podcast. It may be a really good play for you to buy this car in 2022. On the other hand, if you want that Tesla model that qualifies for the $7,500 credit. Remember, a credit is much better than a deduction, because a deduction, if I get a $7,500 deduction and I'm in let's just say a 30% tax bracket, there isn't a 30%, but just the numbers are easy, that's a $2,250 tax savings. But if I get a $7,500 credit, I get $7,500 in my pocket. And that's much better than a deduction. So, talk to your CPA. If you have any questions about that, certainly give me a call. I can help you with all of that. So we have that. The other thing that came up with all this energy incentives is that you and I talked about, and you shared this with me. I think this is great. We have a lot of our doctors who are very charitable people, and they spend times on boards of not-for-profit and their local church or synagogue or civic organization. And Mel, I guess there's some new provisions in these laws that help not-for-profits as far as putting up, solar panel roofs and stuff. Talk about that.
Exactly so. In many ways, this is the big change that was included on that side of the legislation. As you say, under traditional rules, a tax exempt, a charity, a church, synagogue, whatever, they didn't get to play in the incentives that the tax code has for energy efficiency, for alternative energy sources. Beginning January 1 of 2023, the rules change. And in fact, with respect to those incentives, the charity, church, synagogue, state government qualifies. And in fact, instead of a credit, because they don't pay taxes,
right?
Instead of a credit on their return, what they effectively get is a check from the IRS in the amount of what the credit would be. And it's called direct pay. And certainly for those of your listeners that are involved on boards, are involved in just volunteering, this is something that is, because it's things that are out there. It's putting up a solar panel. It's creating some efficiencies with regard to the way the electricity is used in the facility. These are items that solar panel. The IRS will now will now send you a check for 30% of the cost of buying and installing your solar panel, so long as you place it in service in 2023 or later. So don't put it in service today.
Yeah, right. Let's wait till next.
But tell them no. Send the construction guys home. Right. But that is something that was never available before that suddenly becomes available. And there were ways to do it, but it was somewhat cumbersome. And this is really something that it's going to be a relatively simple form, and it's something that I think the bookkeeper at the charity could easily manage with a little bit of guidance. So be aware that it's out there. Be aware that you can take advantage of it, and that you too can. And that's a very good way to contribute, I think, to the whole green movement, is by bringing entities that probably already have an interest in being green, bringing them to the table, bringing them and really showing this additional, 30% off benefit that the government is now going to offer them.
Exactly. All right, let's hit a bunch of topics, Mel, regarding the dentists and what they can do in 2022 to save taxes. Let's talk about the tax rates. The tax rates, other than being indexed for inflation, are not changing between 2022 and 2023 to the best of any of our knowledge, right?
Correct.
So we go from a 10% marginal tax rate to a 37%. So folks, let me explain just for a second. You're going to hear, I have dentists say, well, I'm in an 80% tax bracket. No, you're not in an 80% tax bracket, okay? There's a marginal rate and an effective rate. The marginal rate says that if I make $300,000 a year, I'm in a 24% tax bracket. That means every additional dollar I make up to about maybe $340,000 a year is going to be taxed at 24%. Then once I hit the end of the 24% bracket, it goes to 32. Then it goes to 35. Then once your taxable income is over about $660,000, I believe it is, you are now at the maximum bracket is 37%. So the only change, Mel, is that they index, because I heard there's inflation out there.
Yeah.
Is that true?
Yeah. That's what the economists tell us, and the economists told the IRS. And so we're essentially going to take each of those brackets, each of those trigger points, and move them up about 5%. So there is Again, it just reflects the change, but we're not talking about any kind of a structural change. We're not talking about a change in the top rate applying this year versus 2023.
And the capital gains rates have not changed, nor are they changing. So folks, here's the deal. Remember that an ordinary income item is taxed at anywhere between 10 and 37%. But if I can generate a capital gain on something, that is taxed at either, zero, we'll talk about that in a second, 15 or 20%. Now, in order to get a 20% capital gain rate, I think you've got to have income of over like $600,000. Yes, so most of us mortals are going to have capital gains taxed at 15%. There's no cheaper money. So for this year, 2022, the markets are down. The S&P is down by about 17%. The NASDAQ is down by 30%. The Dow is down by about 7 or 8, but that's just 30 stocks. So there are doctors, some of you are going to have losses in your portfolios, right, Mel? So maybe this is the year, if you want to recognize some of those losses, you only get a capital loss of up to $3,000. So if you have net losses, it's $3,000, the rest carries over. But Mel, what if someone's owned Apple stock from 1872 that they bought at $1 a share and is now split 17 times, is now worth a gazillion dollars? If you've got losses in your portfolio, I can offset them against my gains, right?
That's correct. So This might be a year to harvest. We talk about harvesting losses as a way. Okay, I've recognized capital gains over the year. How much loss do I have in my portfolio? Can I harvest that and offset the gain so I don't pay any capital gains tax? But this is also an opportunity if you have some highly appreciated stock that you do not think you will hold until you pass away. This is an opportunity to recognize some of that gain, knowing you have losses already incurred or losses that you can incur that will offset that gain and effectively keep that out of the tax system.
That's right. And one other thing that we want to talk about too, and it's jumping a little ahead to when we're going to talk about deductions, is if you own appreciated stock. So let's say you bought Apple stock for $1 a share, and now it's worth $100 a share. I haven't looked what it is, but let's just say it's worth $100,000 and you paid $1,000 for it, which is not too far from the truth if you bought it 10, 15, 20 years ago. So if I sell that Apple stock, I have a $99,000 long-term capital gain. Yep. And I'm going to pay, and again, in California, the rate's going to be as high as 13.3%, but let's just call it 10. So I'm going to pay 15% federal, 10% that's California, that's 25%. So my gain, call it $100,000 of a gain. I end up with $75,000 that I can give to a charity. But wouldn't it be better, Mel, if instead of doing that, I just gave the stock in kind? How does that work?
That when I give the stock in kind, I get a deduction, but I don't have to recognize the gain.
Right.
So that is and I get the deduction for the 100,000, not for the 1,000 that I paid.
That's right.
So that is, you can either pay, you are able to significantly increase the value of your contribution by giving the stock, giving the appreciated asset, rather than cashing it, paying the tax, and then just sending them cash.
And the other thing you can do, there's a thing out there, folks, called donor advised funds, which is really cool to use. So let's say that you go to your accountant and you had a big year in your dental practice, and you really want to help you really want to help several organizations. You don't know which ones you want to help: the Cancer Society, the Alzheimer's Society. I mean, whatever society you want to help, but you're not really sure over the next couple of years, and you want to give $100,000. You can contribute to what's called a donor advised fund, which is a fund that says, okay, I'm going to give this fund $100,000. I'm not going to decide where the money's going today, and it's not going to go to the charity today, but it's going to go to the charity sometime in the next couple of years. You get that deduction today, and then you can choose to dole that money out over several years, right, Mel?
That's correct.
Yeah. So that's one thing that we talked about. All right, let's get into quickly about retirement plans. There are three types of retirement plans: baby bear, mama bear, papa bear. Folks, the baby bear plan is the simple IRA, and you can put up to about 35,000 if you put your non-working spouse or working spouse on the plan. It is too late to set one of those up for 2022 because you have to have had done that by October 1st. The second type of a plan is a profit sharing plan where you can put in up to 60, potentially if you're over 50 years old, $67,000. And if you put your non-working spouse on the plan, that's another potentially $25,000 or $30,000 you could put in, and you only have to put in 10 or 15 maybe for your staff. If you want to set one of those plans up, be my guest. You have to have that done by December 31st. And we'll talk about basis in a second. And then if you have a lot of money, 100, 200, 300,000 that you are just going to save it in your personal savings, I would strongly encourage anybody over the age of 35, that's right, 35, to take a look at a cash balance defined benefit pension plan. So if you have any questions about any of this, again, give me a call, 657-279-3243 or awiederman@eidbailey.com. I've been doing this for a long, long time. So the one thing that you have to be really careful about, folks, if you want to go to a profit sharing plan and you already have a simple IRA, you must stop funding your simple IRA as of December 31st. You can fund your last payroll and put the money in the first week of January, but as long as it was for last year, you cannot have a simple IRA in any other type of a plan. All right, Mel, you mentioned depreciation is kind of going to get phased back a little bit. So, folks, another thing that you can do is buy dental equipment. Now, I've heard from different dental suppliers that the supply chain issues are still out there. But there's still stuff that you can buy. You can buy digital scanners. You can buy iCatch. You can buy, all these, CEREC machines if they're available. They have to be placed in service before December 31st. So if an equipment salesman says to you, "Oh, hey, Dr. Schwarz, don't worry about it. Just give me a deposit and we'll send you the equipment next year and you can write it off this year," nope, wrong answer. So, Mel, they're changing you get 100% bonus depreciation this year, but that's starting to phase out, isn't it?
Yes, we lose 20%, essentially 20 points every year going forward. So for 2023, it's going to be 80%. For 2024, it's going to be 60% and on down.
Right.
So that is, and there will be an effort to change that. Given the political situation, I don't think we can count on them being successful in restoring the 100% depreciation for 2023. So if you can get the property in service, that's key. Now, keep in mind, what does in service mean? In service mean? It's got to be in place and available for use.
Right.
It does not specifically have to be used. So, for instance, if you are taking off the week between Christmas and New Year's, so long as the machine is delivered, the machine is hooked up and is ready to be used on a patient, then you are in 2022, even if you have no patient until the first week of 2023.
That's right. And I would recommend that you take pictures, dated pictures of that installation so that the IRS can, again, remember, Mel and I have talked about this many times, not only off the podcast and webinars that we've done together, but on them as well, is that you are not required, folks, to pay one dime more of tax than the law allows you. And, we always I use the term, pigs get fat and hogs get slaughtered. And, I always tell my clients, Mel, there's white, which we'll do all day. There's black, which we never do, meaning, and I'm talking about the, white being an absolute 100% fully deductible, black being 100% totally illegal. And then there's the gray area, which is between white and black. And basically, we talk about that. So, that's kind of how we run the place. And, most of you folks are not CPAs, but you know enough to know the difference between a business and personal expense. We'll save that for the last item before we sign off today. Let's talk about car purchases. Now, but before I go from there, one thing that I would encourage all of you to do, whether it be for the pension plan setup, especially if you're going to use 2023 profits to fund your 2022 pension, because remember, folks, if you set up a plan, you do have until the due date of your tax return, including extensions, to fund that plan. So let's say you have $100,000 and you can fund the plan for 2022. You don't have to write that check on December 31st. However, you need to have what's called S corporation basis. We are not getting deep in the weeds in that. If you write anything down from this podcast today, folks, here's what you need to write down. If you are either buying a piece of equipment before the end of December, placing it in service, or you're setting up a pension plan, you must call your CPA or tax advisor and say the following. Dear CPA or tax advisor, I am setting up a pension plan. I am buying some equipment. Do I have, if you're an S corporation, do I have sufficient S corporation basis to take the deduction in 2022? If they say, what does basis mean? You need to call me. If they say, no, you're good, I've looked it up, I've checked your basis, I've calculated it, then you're okay. So that's very important to know. Mel, automobiles. So there's a difference if I buy a car that's more than 6,000 pounds versus less than 6,000 pounds, right?
That's right. Because if it's more than 6,000 pounds, it's a truck.
Yeah, or it's a big you know what truck,
it's a
right?
Big you know what, and it effectively is taxed pretty much the same way as a truck.
Right. So if you buy a vehicle and it is over 6,000 pounds, GVWR, ground vehicle weight rating, is what that's called. You can find that rating on the inside driver's front door. It will be right there. And it's got to be over 6,000 pounds. I had a client that came to me. There's a GVR rating and a GVWR rating. And the GVR rating for that car was 6,002, but the GVWR was 5,988. And I said it didn't qualify. And I won't tell you what the rest of the conversation was because my client wasn't very happy, but that's the law. So if it's over 6,000 pounds, it's treated just like the purchase of a piece of dental equipment. I get 100% bonus depreciation this year times the business percentage. Now, folks, pigs get fat, hogs get slaughtered. Nobody uses a car 100% for business, but I will, by saying that, get an email, Mel, from somebody who says, Art, I have a car at the office and I only drive it from the office to all my business meetings, so you're wrong. You don't know what you're talking about. Yeah, I'm sure there's one or two people out there that do that, but most of us don't do that. So driving to and from work generally doesn't qualify for business driving, but driving to the lab, driving to see the CPA, driving to CE courses, driving to anywhere that's business related is business driving. So, you've got the maximum deduction for 2022 is $19,200 in depreciation, which is $11,200 for the depreciation and $8,000 for the bonus part. And then that's going to go down each year as you continue to depreciate the car. So if you want a full write-off, the $6,000 car is the way to go. Do you want to own a car that's 6,000 pounds, that gets 3 miles to the gallon? And we're still at $5.50, $6 of gas here in California. I love when they say the average gallon of gas is $3.40. I was in Columbus, Ohio 2 weeks ago. I went to the Ohio State-Michigan football game. I'll tell you what, if you're an Ohio State fan and you were in that stadium, I've never heard 107,600 people so quiet in my entire life in the second half. It was a fun game to watch, especially if you were a Michigan fan. And I'm not going down that road either because I will get death threats. But when I was in Columbus, the gas was, $3.50 a gallon. So it's all different in all parts of the country. So we got automobiles. And then the last thing we'll talk about, Mel, is children on the payroll. If you have a child, the standard deduction. So they changed the standard deduction in 2017, didn't they?
Yes, they significantly increased the standard deduction with the idea that they wanted people to be able to take the standard deduction and not have to go through the bookkeeping problems of itemized deductions.
So the way this works, folks, is this. In state taxes, meaning your real estate taxes, your state income taxes, for those of you who live in the 41 states that have them, DMV fees, other taxes that are deductible, you are limited to $10,000, period. That's not changing anytime soon. So let's say that you have done a good job, you've paid your house off, or you've paid it way down, say you have no mortgage. I get $10,000 for taxes. I get nothing for home mortgage. And the other big thing is charitable contributions. Well, again, when I talk about charitable contributions, folks, it is only in the context of taxes. Giving money to charity is a very, very personal thing that every human being has to decide how much or how little they want to give. But, maybe you only give $5,000 a year to charity. And I say only, maybe you give $5,000 a year to charity. That's $15,000. You would much rather, Mel, use your standard deduction of $25,950. So, folks, if you're going to be in the standard deduction, you don't want to make another $1,000 or $2,000 of charitable donations in 2022. But maybe next year you're going to give $20,000, $30,000, $40,000 to your dental school and their endowment fund to build a new dental building, a building for the dental students or something like that. So you want to bunch your charitable donations into a year where you're going to have enough to put you over the standard deduction. Again, that's why all of you should be sitting down with your CPAs and talking to them about what can I do to save taxes. I was just on a call, Mel, with one of my best AAA plus clients, and he's looking at selling a partnership interest in his partnership to another dentist. And he said, Art, should I do this before the end of the year or after the end of the year? And we looked at where he was this year, and their practice bought a ton of equipment this year. So we decided that if he sold it in 2022, okay, he would only be in a 24% marginal rate, whereas if he sold the interest in 2023, he would be, and there's recapture tax that was involved, it was the ordinary income part, he was going to be at 32%. So that's what you need to be doing with your CPAs, folks. And that's what we at Eide Bailly are really good. There's lots of smart people in this firm, Mel, I've found out, being part of it for 2.5 years. All right, last thing I want to touch on, and this is your kind of bailiwick is, so let's talk about IRS is doing about audit rates. I mean, everybody, it's like, I almost feel like everybody thinks that nobody's getting audited, so I can run the dog and the bird and the fish and the poodle through the practice, right? And so, and I know that the IRS doesn't want to, the IRS could balance the federal budget by auditing 50% of returns. Number one, they don't have the manpower to do that. Number two, politically, that would be suicide, right? If they did
I think that's correct, yes.
Right. So, but let's talk about the audit rate. We have this $87 billion. How are they doing as far as auditing small businesses? Are they increasing the auditing of small businesses? What's happening in Washington on that?
But I think we are going to see an increase in the auditing of small businesses. We're going to see an increase in the auditing of small businesses as they look for specific things. We keep coming back to ERC, the Employee Retention Credit. That is one of the ones that they're going to look at. There does seem to still be a sense that they're trying to honor the $400,000. So if your income, and here what the income before deductions, the income is $400,000 or less for a married filing couple, I don't think your percentage chances are likely to go up that much unless you've got a trigger on your return. And triggers come in lots of different flavors, and it connects very closely with your statement of pigs get fat and hogs get slaughtered. Right. So, things that stick out, things that have been associated with misbehavior by others, let's say. You want to be, they do. They're going to raise your risk of examination. How much, we can't say. But it is, I think that for the pretty much straightforward filer, there's going to be very little change in the incidence of exam. We're going to see, to the extent that the service knows where the money is, and the money is not in an individual small business. The money's over at Microsoft.
That's right.
That's who you collect the. If you're going to try and raise revenue, that's where you go collect it. It's like Willie said about the bank. Why do you rob banks? Well, that's where the money. They are the ones.
That's where the money is. Willie was a smart guy, you know.
So I don't think it's something to be afraid of. I think it is something to be conscious of, in the sense that you don't want to make a spectacle out of yourself.
Right. The one thing I want to make, and this will be the last point, and then unfortunately, Mel, we have to call it a podcast, is this, folks. When you run your business, if you choose to be more aggressive in the deductions that you take in your business, the expenses you pay through your business, Costco, Home Depot. I mean, I've never seen that go through. My favorite deduction that I saw go through one of my clients' books was a credit card charge to Victoria's Secret, which he called uniform allowance, and I just lost it right there. You know. But, if you're going to be aggressive, you want to do on the deduction side. I will be adamant about this. I have fired 3 clients in my career over this. You must report every dime of income that you receive, not negotiable. I had a consultant 20 years ago called me, Mel, and said, did you know that this particular doctor is receiving $7,000 to $9,000 a month of cash and not putting it in the bank? And she said, okay. I said, what do you want to do? I said, I want to have a meeting. We had the meeting, and I asked the doctor, so is this true? And the consultant was sitting right there. And the doctor said, yes, this is true. And I said, why are you doing this? And the answer was amazing. Art, because if I didn't do it, you'd make me pay taxes on it. I said, okay, thank you very much. As of right now, I'm terminating my relationship with you as an accountant. Because remember, folks, you sign your tax return under penalty of perjury. Penalty of perjury, they send people to jail for. So you're not going to go to jail if the IRS disagrees that a particular expense in your business is not a legitimate deduction. You're not going to go to jail if you claim 80% business use and the IRS lands on 65% business use. You will go to jail if you take a bunch of money into your business and you don't report it as taxable income. Mel, am I off base here?
You are completely correct.
Right. So that's the one point I want to leave. Mel Schwarz, Director of Legislative Affairs at Eide Bailly, you are a wealth of knowledge, and I am so glad to know you because it really helps me deliver the message to my listeners and to my audiences. Folks, if you have a chance to listen to the podcast that Mel and I did, it's 2 hours, a deeper dive into tax planning and all these subjects that we just don't have the time to do in a podcast that lasts a little less than an hour. So feel free to go onto our Eide Bailly YouTube page and look up December 2nd webinar for that. And look at our entire Business of Dentistry webinar series, and our transition series is all on our YouTube page. It's there to be had. And if you want a link to it, we can send it to you. Mel, hang on as I take this thing out, as I take the podcast out. Thank you so much for your time and expertise today. I appreciate it.
Thank you for having me, Art. It's always a pleasure.
And folks, don't forget to go onto our website of our wonderful partner, Decisions in Dentistry Magazine, www.decisionsinDentistry.com, 140 continuing education classes at a very, very reasonable price, and the best clinical articles and information regarding helping you to be a better clinical dentist that you're ever going to find in any publication anywhere. They have a great website. They have a great magazine, www.decisionsindentistry.com. If you are listening to this podcast and you hear all this stuff and you say, wait a minute, my CPA doesn't help me with any of this. I never meet with him. I always get a call on April 14th that says I owe $75,000 and I don't like that anymore. Give me a call. We can make that not happen to you anymore. We right now are working very hard in the months of October, November, and December, meeting after meeting after meeting and calculation after calculation to try and help you to pay as little money as you can. My job is to increase the federal deficit and the federal debt as much as I possibly can by cutting your taxes. Give me a call, 657-279-3243, or A. Wiederman, Wiederman, at Eide Bailey, EIDEBAILLY.com. And with that, folks, that will be it for this edition of The Art of Dental Finance and Management with Art Wiederman, CPA. Again, please tell your friends about the podcast. I think there is an organization that is sending out to dentists about voting for your favorite podcast. I voted for my favorite podcast. I wonder if you can guess which one that was, but please vote for me. There's lots of them out there. I'd love to get some votes. That would make me feel good, stroke my ego a little bit, but I don't get anything for it, but that'd be nice. And with that said, this is Art Wiederman for The Art of Dental Finance and Management with Art Wiederman, CPA, signing off. We'll see you next time. Bye-bye.
Thank you for listening to today's episode of the Art of Dental Finance and Management podcast. Be sure to subscribe wherever you listen to podcasts so you never miss an episode. The Art of Dental Finance and Management podcast is produced by Eide Bailey in partnership with Art Wiederman, CPA, Decisions in Dentistry Magazine, and the Academy of Dental CPAs. For audience questions and feedback, email Art Wiederman, Wiederman at eidebailey.com. That's AWIEDERMAN at EIDEBAILLY.com. Or you may call Art at 657-279-3243.